Welcome back, everyone. Today on the Joseph Carlson Show, I'm excited to look at a video of Mark Mahaney. He's from Evercore ISI, and he is a stock picker. He's a tech investor, and just a couple days ago, he released his top 3 tech stock picks. He's had good coverage on stocks so far. His top pick during 2022 and 2023 was Meta, and obviously Meta did incredibly well. So he's done well so far. We're going to take a look at his next top 3 picks and see what we think of them. Now, of course, we have some other news to get to. Target stock has been in trouble for a while. It's been on a downtrend, but it's starting to reverse. In fact, just today, the stock is up 12%. They just reported earnings that were better than expected. And they even gave optimistic guidance. They said that people were turning to their bargain deals. Now, Target CEO went on to explain the quarter and to give an update on the consumer from his perspective. And he also addresses some of the commentary going around that companies like Target are price gouging. We'll be looking at what he says about price gouging as well as what the data says. Now, finally, we have Netflix stock hitting an all-time high. This has been one of my central investments. Now it's my best performing company in the Story Fund. Now, it reached an all-time high, not a 52-week high. So this is brand new territory for Netflix. And I put a post up saying that it reached an all-time high on social media, on Twitter and on my YouTube. And it got a lot of negative reaction. A lot of people that seem to think that Netflix is a gamble. One user saying $6.7 billion in annualized free cash flow with a $295 billion market cap. That's 44 times free cash flow. That's gambling in my book. Another person saying, Joseph's whole portfolio. Don't look at the forward PE, whatever you do. The truth is, when there's a proper correction in the market, all of these front runners will get heavy earnings compressions on their stock. It's the definition of picking up pennies in front of a steamroller. Am I playing a dangerous game with my portfolio? Am I picking up pennies in front of a steamroller? We're going to discuss in this episode. Now, we'll start today by looking at the top 3 tech stock picks from Mark Mahaney. Now, Mark Mahaney is someone that's a bit unique. In most cases, I don't really follow analyst picks. In fact, I believe most analysts are not worthwhile. They don't offer any alpha. They don't have any real insight. Most of them offer you trend following, vapid, vague mush. They just follow kind of whatever's going on in the market, and they don't diverge from the path. Most analysts are not worthwhile to follow. But Mark Mahaney's a little bit different. He has a really good track record, so most of his picks are actually quite good. He's also wrote a book on the subject. It's called Nothing But Net. I've read the book. I think it's an excellent one. It's a great one for any tech and growth investor. And he focuses primarily, in fact, he focuses solely on tech growth investments. So this is his wheelhouse. This is the type of stocks that he focuses on. Let's go ahead and just take a listen at his commentary behind these 3 companies.
Okay, your top 3, Amazon, DoorDash, and
Uber.
Yeah, and Uber.
Uber, even with the robo-taxi concerns, I still like Uber. I think we're going to look back on this 2 or 3 years and say that Uber actually won from the emergence of robo-taxis. And I know this is going to take a long time before we see robo-taxis roaming around Manhattan, but we're seeing them in San Francisco, so just wait.
The first one he brings up is Uber, and he immediately addresses the robo-taxi concern. Because if you're looking at investing in Uber, if you're doing research on this stock, the first thing you'll come up with, the first big concern is the concept of robo-taxis becoming a bigger and bigger thing. Theoretically, if there's robo-taxis going around everywhere, then couldn't they take over what Uber does? Uber has to pay for drivers. Robo-taxis are autonomous. So robo-taxis seem like a far more efficient, cost-effective way to do the same thing that Uber does. So that's the big concern. And he says, even if that happens, even if robo-taxis become a thing, he still thinks Uber is going to be a winner. Now, he doesn't delve into why. He doesn't give all the details. Maybe it's a timing thing, or maybe he thinks that robo-taxi companies will operate with Uber, that there will still be a network effect. There's a lot of different reasons why Uber could still win, even with robo-taxis. But the one thing he does mention here, and I disagree with this a little bit, is he makes it sound like robo-taxis are in the distant future. Like it's only happening in California and some parts of the world, and it's not going to be happening in New York or other places very quickly. Most reports show Quite the opposite. The expansion of the robotaxi is being led by Waymo, which is owned by Alphabet or Google. And they just recently released a report that Waymo is doubling down. Alphabet's Waymo said on Tuesday that it had doubled its paid rides to 100,000 per week in just over 3 months as the autonomous ride-hailing firm expanded its areas of service and allowed more people to ride its robotaxi. Waymo's expansion comes just a month after Alphabet said it was planning on a multi-year $5 billion investment in the company, even as autonomous vehicle technology continues to face widespread skepticism. And right now, Waymo is the only US firm operating uncrewed robotaxis that collects a fee. So they're really the only one doing this. Tesla's trying to take a different direction, but right now, the only company really having a robotaxi that collect fees is Google. And they're putting a lot of effort into this. They don't seem skeptical about it at all. And there's even more reports that Google's stretching their money further with the robotaxis. They're refitting them with cheaper parts. They're not buying the Jaguars anymore. They're doing vans and different bigger concept vehicles. So they're even now becoming more cost efficient and cost effective. So this is a real thing. Whether or not we like to believe it or whether we have skepticism, in every major US city, and they'll start with the biggest ones and work their way to smaller and more rural cities. But at least the largest cities are going to have robo-taxis. Now, it is true, from Mark Mahaney's perspective, that it will take years and years for this to fully saturate. And it will take a lot of time until robo-taxis are in every smaller city. But in the meantime, that is going to be a constant theme overhanging Uber, always overshadowing the company. How will it do with the constant threat in the future from robotaxis? Mark Mahaney is making a bet that Uber will outperform. It's going to beat the market, even in spite of that looming threat. And I think there's a good chance he's correct. I think in terms of timing, Uber could make a lot more money by the time that robotaxis are fully saturated. Now he continues on explaining why he chose Uber over their competitor Lyft.
Let's just like Pepsi versus Coke. Pepsi's got all this other stuff. Coke's just beverages. Does Lyft need some of the other things? Because there was a question as to whether Uber was trying to do too many things, but it seems to be paying off, right? Is that Lyft's problem?
I don't know what that's a decent analogy, but I'd probably stretch it even more.
Saturday Night Live, Coke, Pepsi, Coke.
Yeah, no, I'm with you. Pepsi, and then it's the company that owns Coke and a lot of other brands too. Like, what you have with Uber is both mobility and delivery. What you have with Uber is a global play, whereas Lyft's just mobility, just in the U.S. That means its TAM, its total adjustable market, is smaller. You don't normally make money investing in the number two player. Now, there may be a lot of trading opportunities around Lyft, but I don't think it's a long-term investment vehicle.
He says something there really important, and this is because of his long-term pattern recognition, his 20 plus years of experience investing only in tech companies. He just mentioned that you typically don't make a lot of money investing in the number two player. Tech investors with a lot of experience will tell you that in most cases, it's a winner-take-most situation. The largest scaled companies typically take the majority of the gains. This is why I pick companies like Amazon or Netflix. They are the largest scaled winner, and they're going to take the majority of the gains. So with Uber compared against Lyft, part of the reason he picks Uber is not only because it's more diverse in its offering, but because it's already the number one player. It's the largest one. So that in and of itself is a reason to choose the company over its competitors.
I really like Uber here. I think it's also very cheap versus its cash flow.
He also mentions that Uber is cheap compared to its cash flow. Well, we can check that statement. If we look at Uber right now, in the trailing 12 months, it generated $4.81 billion in free cash flow. So we can say around $5 billion in free cash flow. The company currently trades at a $150 billion market cap. Overall, that's not too bad. When you look at the free cash flow it's generating, its current yield, and the growth rate, it's not an expensive company based on the free cash flow. Now, the second one we bring up here is DoorDash. This is one that's similar to Uber, but it has some unique differences. It's not focused on ride sharing. It's just focused on food delivery. And his big thesis for DoorDash is that it's something new. It's at the beginning of a secular trend. It's not at the end of it. And he even compares it to other industries that have been around for a lot longer, like online travel.
Across the board, travel seemed weak.
Yes, it did.
Why?
I think it's the most well, for internet companies, it's the most discretionary part of spend, and it's the category that's most penetrated online. Internet's been around for a long time. One of the earliest manifestations of it, the use of the internet, was booking travel online. So it's not like there's that much secular growth. Whereas DoorDash and Uber, I think, have got a fair amount of secular growth ahead of them. So they're less They're less macro
DoorDash is.
So the argument here from Mark Mahaney is that companies like online travel agencies, Booking Holdings and Expedia, have been around for a long period of time. They're one of the first and original use cases of the internet. So it's already somewhat saturated. There's already the market there that's been established, and the gains will be what they are, just steady growth in that industry. With things like DoorDash and Uber, where you have food delivery, that's new. If you go back 20 years, that didn't exist. If you go back 15 years, that did not exist. DoorDash and Uber invented this category. It's relatively recent that we can go on an app, pick out what food we want, and have it delivered. So the way that he views companies like DoorDash and Uber is that they're at the very beginning of this long-term secular trend, the next 10, 20, or 30 plus years of food delivery. Whereas other companies that have been around much longer have already been saturated, they're already a little bit older and more mature. Now, when I look at DoorDash, this is actually a company that I've had in my portfolio before. It's been in the Story Fund. I sold it in late 2021, early 2022, because the company didn't really have the fundamentals I wanted at the time. In fact, if we look at that time period, the free cash flow was not great. The free cash flow is only a couple $100 million, barely profitable. And this is what these companies do. They invest a lot back into their business to reach scale, to beat out their competitors like Grubhub and Uber. Once they reach scale, then they focus on efficiencies and profits. And you can see this step up every single year in free cash flow. It's true that stock-based compensation eats away at some of this, but now it's at the breaking point where the free cash flow is far outgrowing the stock-based comp. So DoorDash is now a profitable business model. It's a real money-making company. Another reason that I like DoorDash in particular is if you compare DoorDash to other businesses. For example, we can compare DoorDash to Peloton. One of the key differences in DoorDash is it does something that's based off of convenience, leisure, and laziness. It makes your life easier by paying someone else to go pick up your food. That's something that all of us want. We want to have convenience. We want to be catered to. We've seen this in all different industries. A company like Peloton requires an enormous amount of effort and dedication and discipline to continue paying for something to work out. DoorDash is the exact opposite. It preys upon your laziness, your compulsiveness, your want to get something without any effort. And between those two business models, it's very clear which one is more sustainable. Companies that offer more convenience, more ease of use for your everyday life are typically successful businesses. Amazon with 2-day shipping. It's so easy. You just pick something out online and instantly it shows up at your doorstep. You have Netflix, which how much easier can life get? It's ubiquitous streaming on every device. And then you have in similar fashion, DoorDash. You customize the meal you want, you hit order, and then you get to sit back and wait for your food to arrive at your doorstep. And even though DoorDash, in some cases, charges an enormous markup, it's double what the normal meal costs, people will still pay it because they value convenience that much. Even though they know they're being price gouged in the cost of the meal, most people still pay for it because it's convenient. Now, his third top pick is Amazon. Amazon remains a top buy for Mark Mahaney, and it's remained one all year long. He doesn't go over the entire thesis in this video, but he goes over the AI aspect of it.
Is anybody showing a return on all of this AI spending? Is there an ROAI? And I think if you look hard enough, you can find that evidence. If you look at Meta, if you look at Amazon, if you look at Google, the three biggest spenders that are spending, I don't know, $150 billion in capex capital expenditures every year on AI, I think you're starting to see these returns. AWS growth acceleration, Meta being able to improve its products and its user experience and seeing rising usage and rising return on ad spend. So I think you're starting to see the evidence come in that they're getting a little bit of a bang for all of those bucks they're spending on AI.
Meta's possibly the first big tech company to get real returns on their AI spend. AI helped enhance the ability for them to advertise effectively. So Meta got really good returns on AI spend, better than most investors were predicting. Then you had Google coming out with lots of AI products. You have Microsoft infusing their entire applications with AI products. And it's been more difficult to measure the total return they're getting, but he believes it's going to be similar to Meta, but just take a little bit longer. All of these big tech companies have different ways they can advance their applications and their business with AI. With Amazon in particular, I think that this is going to be a massive AI winner. Everything takes time with a company as big as Amazon, but there's so many ways this company can benefit from AI. Not only AWS and enhancing that entire product, which is a huge portion of Amazon, but also with Amazon.com, their advertising business, the effectiveness of their listings. Even the reviews on Amazon items are now being summarized by AI. They could use AI to enhance their warehouses. Amazon has over 500,000 robots working in their warehouses along with humans. So a huge portion of their staff already is robots, and AI can certainly enhance that. We also know there's different products like Alexa that could benefit dramatically from AI. So there's so many different use cases for AI with Amazon that I think it's going to take some time, but over time you'll see the return on their investment in AI. So there you have it. His top 3 picks are Amazon, Uber, and DoorDash. All 3 of these companies have fast improving free cash flow, so they're all headed in the right direction. It's unknown what will ultimately happen with DoorDash and Uber, with robo-taxis, but I agree with him that in the short term, over the next couple of years, I think there's a high probability each of these companies will outperform. Now, finally, we move on to Target. This is a company that currently, right now, the stock is up 13%, so it's having a really good day. We have from Qualtrim here that it's trading on better than expected earnings. Now, we also have the CEO of Target going on to CNBC and giving a basic breakdown of this quarter and why the stock is up so much.
Well, it's been a good day for the Target brand and a great day for the Target team. And I think we checked a lot of boxes today. If you look at the P&L, and you reported it earlier this morning, we said Q2 was a time we'd get back to growth, and that would be driven by traffic. Traffic up 3% was a really important marker for us. But overall comps plus 2%, stores were positive. We saw acceleration in digital. Digital growth led by Drive Up and our Target Circle 360 delivery to home. Those were up over 14%. And from a overall performance standpoint, for op income rate to get back to 6%, people have been waiting for that for a while.
6.4% actually.
And to see EPS up over 40%, I feel really good about the progress we're making in the quarter.
That's a great report. Same-store sales are up. There's increased traffic. Earnings are up. They're getting more digital traffic. I like everything I've heard in this report. So far, this is a great quarter from Target. And he goes on to explain the forecast of the future and what he sees in terms of behavior of consumers and ongoing demand.
Well, the 3 of us have talked about it quite a bit over the last couple of years. We continue to see an incredibly resilient consumer. Now, they've been facing the pressure of inflation and rising interest rates. They're continuing to look for value. But we've seen a pretty steady consumer environment. I think part of it is we still have a very strong labor market. But a consumer who's managing their budget carefully, they're looking for value, and we're delivering value right now.
Target sees a strong consumer, and so does basically every other retailer at this point. Walmart just had fantastic earnings. Costco, of course, is marching up higher and higher with their revenue. Amazon is also doing great. Online sales are growing as well. So Target's one more company beating the same drum that consumers are strong right now. Now, one of the criticisms that's come up for companies like Target and Walmart is the subject of price gouging. We know that lots of retailers are facing inflation, higher costs of goods, and a lot of things you buy at the grocery store are 30% more expensive than they were just a couple years ago. So a lot of customers are going to the grocery store and saying, I can't believe that Target or Walmart or my local grocery store is charging me this much for this item. It was half of that just a couple years ago. What's the deal? They must be price gouging me. And this has become more and more popular over just the past couple of months. Here's the Target CEO being asked specifically about that criticism, the possibility that they're a greedy company price gouging consumers, and that's the reason that your groceries are so expensive.
Gouging on prices yet, Brian? And how prevalent and pervasive do you think that was in terms of causing the recent 40-year highs in inflation?
Joe, again, we talked about the fact we reduced prices on 5,000 items, but value's in our DNA. You go back to the brand promise, expect more, pay less. It's what we do each and every day.
You haven't done that. Do you think it's that? Do you know anyone who has? Any of your competitors? Yeah. Supermarket?
I'll put my retail hat on for a second. I mean, you two talk to industry leaders in every different sector. Is there a more competitive space than retail? No. Big multinationals,
or lower margins, or lower overall margins.
Right. We're celebrating this morning the fact that we delivered, a margin rate of over 6%. You talk to other CEOs who are delivering op income of 20, 30,
tech
40,
companies.
and 50%.
Yeah, tech
so
companies.
We're in a penny business.
Well, should we go after them?
Well, I think from a retail standpoint, though, you've got physical stores, you've got digital stores, you can shop socially. people could pull up their phone like Becky and check the price of milk at Target and other retailers.
She does that too. So does Andrew.
So it is a penny business.
He repeatedly mentions that it's a penny business, that they're focusing on prices down to the penny. Now, I've seen a lot of dumb criticisms for big companies, consumers complaining about different things that aren't necessarily the best things to complain about. But this one in particular, the idea that retail companies are price gouging, is one of the most ridiculous ones that I've ever seen. We can take a quick look and examine why retail companies like Target and grocery stores can't price gouge. They literally can't. If you take Target, for example, and we look at their profit margin, we can take a look at it right here under the ratios. We go to profit margin, we zoom in. They have a profit margin of around 4%. Now, Target's on the higher end. This is the higher end of grocery store profit margins, because Target has a little bit nicer of a shopping experience. You have the plastic carts, you have Ulta Beauty inside, you have Starbucks inside. It attracts a bit higher income shopper. So the 4% profit margin they have, this is the high end of retail. If we go to other companies, we can take a look at their direct competitor, Walmart, which again, if Target decided to price gouge, all of their customers would just shift over to Walmart. Over 90% of the US is within 15 minutes away from a Walmart, so they are everywhere. A direct competitor, their profit margins are 2.7%. We can look at Costco. Even when factoring in the membership revenue from Costco, when we look at the profit margins of the company, it's 2.87%. And that includes the membership. So that's not just the groceries you're buying. And just so you can see I'm not cherry picking, we can look at Kroger's, another massive retailer. If we look at their profit margins, it's 2.8%. The Target CEO is completely accurate in saying that these companies aren't price gouging. How could they? If you took any one of these companies, hypothetically, and you said, well, we're going to raise prices on consumers to take advantage of them, it would be very easy for customers to go to a different business. If suddenly everything got way more expensive at Costco, people would stop shopping there. If suddenly everything got way more expensive at Walmart, they would go to Kroger's. Whatever company tries to price gouge, there's always 4 or 5 massive competitors willing to take market share by undercutting them. The entire retail industry is one of the most intensely competitive, lowest margin industries in existence. It is completely absurd and misguided that people believe that industry is price gouging. The reason prices are going up for groceries and common goods is because the price of everything has gone up. Inflation. All of these companies' input costs have gone up. The price of agriculture, the price of oil, the price of transportation, the price of labor, the price of healthcare. Every single input cost for all of these retailers have gone up. And so the prices overall of things have gone up. But it's not because these companies are earning more money. They are earning the same profit margins they have for the past 10 years. In fact, for most of these companies, the profit margins have declined over the past 10 years. Now, companies that you could accurately accuse of price gouging, and at least it would be not a misguided statement to say these companies price gouge, is maybe Apple with the 30% Apple fee. That seems more like a price gouge, and there's really nowhere else you can turn except for Apple. Maybe FICO for the FICO score for home origination and other large purchases. That score is going up like crazy, and they have unmitigated pricing power. They have no competitors. The margins are incredibly high. The dynamics for those type of industries are where you find the price gougers. But you don't find them in retail. You're not going to find much price gouging in the retail industry, because if any company tried to participate in price gouging, immediately other companies would take share. Now finally we move on to Netflix. This is a stock that's reached an all-new all-time high. So it's not a 52-week high or a yearly high. This is an all-new high for Netflix. It's up 50% year to date. And this has been one of my key holdings in the Story Fund. It is now a $73,000 position, and it has currently $27,000 in gains. It's my biggest winner in this portfolio, above Microsoft, Google, and Amazon. So Netflix has turned into quite the winner, and that shouldn't be surprising if you're following the fundamentals. Netflix is dominating. In every part that you can track, this company is on a roll. In fact, the most recent report is that Apple TV, a would-be competitor to Netflix, is cutting back on its spending after it can't keep up with Netflix. In fact, Apple has tried so hard to gain share on Netflix, to gain total watch time, it's just not working out for the company. Even with all of their money and their high-quality TV shows and their massive distribution with all of their devices, Apple has failed to take any meaningful market share from Netflix. In fact, according to this report from Bloomberg, in an entire month of Apple TV, you have less total viewing time than a single day of Netflix. That shows the monumental lead that Netflix has. But now, in fact, in 2024, it seems that Wall Street and investors alike are finally realizing the lead that Netflix has. In fact, they say that there is a growing sense in Hollywood and on Wall Street that Netflix has built an insurmountable lead. That's the exact wording they used, and I used that exact wording as well, but only 3 years ago. The massive scale Netflix enjoys, with 223 million subscribers and a high average revenue per user, gives Netflix an insurmountable advantage. Given the fundamentals, it makes perfect sense that Netflix stock is trading up. When a company is a runaway winner in a highly profitable industry that has worldwide scale, typically those companies trade a little bit higher than the average company. But according to some investors, especially some of my followers, not everyone's convinced. In fact, if we look at a couple comments here, here's the comments I received from posting that Netflix was at an all-time high. Matthew here said that Netflix has $6.7 billion in annualized free cash flow, a $295 billion market cap, which is 44 times free cash flow. That's called gambling in my book. So according to Matthew here, my investment in Netflix is nothing more than gambling. Now, Matthew isn't alone in this criticism. There's many more comments with different investors sharing the same sentiment. We have here from Phil. Joseph, buybacks when severely overvalued, not a good use case for shareholder funds. Joseph's whole portfolio is, don't look at the forward PE ratio, whatever you do. The truth is, when there's a proper correction in the market, all of these front runners will get heavy earnings compression on their stock price. To add, it's the definition of picking up pennies in front of a steamroller. Now, these commenters do raise an interesting point, and this is one that I've seen for the past 5 years in investing. And that is, no matter how much data and analysis and research conclusively disproves something, even though it's conclusively and ultimately disproven, there's still going to be a group of people that still continue to make the same point, even though that point is disproven. So let me try one more time here. And I'll just do this because I think it's necessary for some people. For some of you, you'll already know this, but I think it's important for a lot of people that may not. But a PE ratio, a forward PE ratio, does not tell you the valuation of a stock. It doesn't tell you whether or not a stock is expensive or cheap. A company trading at a forward PE ratio of 40 may be expensive. It may be cheap. We don't know. If that's the only thing that we know about the company, that it has a 40 forward PE ratio, we don't know whether it's expensive or cheap. If a company has a 5 forward PE ratio, it may be expensive or it may be cheap. We don't know. We have no clue. We don't have the information to fill in a conclusive analysis on the valuation of the company. Forward PE ratios and free cash flow yields in and of themselves, when they're isolated from all other data, are meaningless. They mean nothing. You don't know if a company trading at a 70 forward PE ratio is expensive or cheap. Because to inform you whether or not a stock is expensive or cheap, you need to know profit margins, growth ratios. You need to know the returns on capital employed, how effective they are at reinvesting their money and the amount of money they are reinvesting. You need to know their capital allocation policies. You need a lot of other factors to determine whether or not a company is really undervalued or overvalued. So when we look at a company like Netflix, it's trading at a 36 forward PE ratio, but that doesn't necessarily mean the stock is expensive. And alternatively, we can look at a company like Ford. Ford's a company trading at a 5 forward PE ratio. So is Ford cheaper than Netflix? Well, some people may think so. If you think that the forward PE ratio is the only thing determining whether or not a company is cheap or expensive, then you may look at a company like Ford without anything about their profitability, their margins, their returns on capital employed, their growth rate, and you may incorrectly conclude that Ford's a cheaper company. In reality, Ford today is a more expensive company than Netflix. And by that, I mean you're paying more for what you'll get over the next 10 years. Even though Ford has been a cheap company based on a PE ratio, over the past 10 years, it's gone down 40%. Netflix is a company that's always traded at a higher PE ratio. Investors have for the most part correctly priced in a better future for Netflix, but still not as good as the future held. So even though Netflix traded anywhere from a 30 to 54 PE ratio, the company has dramatically outperformed the market over the past decade, going up 921%. So I look at a company like Netflix, and of course the PE ratio is higher than the average PE ratio of the average company, but Netflix's growth rate is also higher. It's growing revenue by 16% per year, which is higher than almost every other big tech company and almost double the speed of the market average. Netflix's margins are also much higher than the average company, at 27% operating margins, and Netflix's margins are expanding every single year by an average of 300 basis points. So when I look at Netflix, given the totality of different factors to factor into the price of the stock, when I look at a 36 forward PE ratio, I believe Netflix is cheaper today than Ford, based on the future growth, margin expansion, durability of moat, and future cash flows. This company will have better returns in the future than Ford. Michael Malbison, in a research article, proved definitively that if you look at the Ford PE ratio of a stock, without considering the growth rates and the return on capital employed, you know nothing about the valuation. The Ford PE ratio in and of itself tells you nothing. So can we finally just stop this whole argument of looking at stocks and if they have a high Ford PE, they're expensive. If they have a low Ford PE, they're inexpensive. It may be the case, but it may not. And you need more data than just the Ford PE to show whether a company is expensive or cheap. So there's my thoughts on those comments. Let me know what you think. Maybe I'll do that more frequently. But that's all for this time. Hope you enjoyed. See you in the next one.